So we start off looking at demand. We're expecting quite a lot of changes this week. So in terms of temperature forecast, they're dipping below seasonal norm, and that's going to see day-ahead gas and power demand increase. On top of that, specifically to power, we're seeing French nuclear outages continue, and that's seeing exports to France from the UK via the IFA, which is essentially a big extension lead between us and the continent. Exports are quite strong at the moment, and typically this time of year we'll be looking to import. Now, because we're exporting and we'd usually import, the detriment is kind of doubled. So we're currently exporting around 2 gig, where normally we'd be importing. So there's kind of a 4 gigawatt net difference there. In terms of gas, the key fundamental this week is going to be Rough storage. With the start of November, this is when Centrica's announced the start of the availability for withdrawals. If we see any changes to what's been announced previously, that's going to prompt some price volatility over the short term. And finally, the moving of the clocks and the end of daylight saving, that's potentially going to see consumption for power increase as lighting demand increases, because we get into the evening an hour earlier and obviously lights come on a little bit quicker. So starting with contracts close to delivery, if we look at day-ahead gas, that's still trading at 19-month highs, and again that's been linked to fundamental changes. So we've seen a lot of outages and subsequently the supply into the UK has decreased. On top of that, demand's been stepped up over the last few weeks, linked to gradually cooling temperatures. Looking at corresponding power contracts, they're also a lot higher and remain very volatile. At the moment, with the outages in France and then concerns of our own domestic production in terms of power, we're obviously seeing prices range anywhere from kind of 70 down to 50, and that volatility is putting some upward incentive onto seasonal contracts. So specifically power, again we're trading at kind of multi-month highs, highs for over 12 months, and that's linked to the volatility we're seeing over the short term, as well as the expectation for tighter margins later in winter and maybe start of summer 17. Finally, in terms of gas seasonal prices, again trading at 17-month highs. The uptrend is now very much in force, and at the moment there seems to be a lot more upside risk than downside potential. So customers looking to place a fixed price contract, I'd urge you to do it for the front 12 months ASAP. In terms of 24 to 36 months, it's down to attitude to risk. There is potential for prices to turn lower at the start of next year if we get very low demand during winter, but it's by no means assured. So if you're looking at prices now and think they're reasonably good value, I'd recommend hedging out for a further period. In terms of flexible contracts, there's 2 key points we need to discuss. Firstly, supply agreements. So ideally you need to get either extend with your incumbent or run a fresh tender to make sure you're in a supply agreement as far as you possibly can, and that'll allow you to capture current lower prices further out from delivery. In terms of trading, at the moment we're very clearly in an uptrend, so the view from us would be to increase your hedge appropriately, with a view to potentially unwind those hedges later down the line if we see prices turn lower. Now, in terms of the wire report and how it's made, if you wanted to find a bit more information, you can go to the Energy Live 2016 event, which is on the 3rd of November in the Barbican in London. And at this event, we're basically doing a live wire report, which will show a bit of information about what goes into making them and the background research that we go through in order to give you up-to-date information.